Yeah, one last thing
All right.
is that I think it's the silliest thing in the world to screen for high dividend stocks because there's no other world investment class in which people do that and think it's a good idea.
Okay.
In fixed income, in bonds, if you look at the high interest rate bonds,
The highest yielding bonds,
yeah, nobody looks at a high yield bond.
they're the
In
crappiest companies.
yeah,
Yeah.
and in a high yield bond, that is guaranteed payment to you. That
Yeah.
guaranteed in the sense that the company has an obligation to pay interest to you. Nobody looks at that and says, "Wow, this is such a great deal. I'm getting an awesome return on my bond." They understand correctly that these are riskier investments that are paying a higher rate of interest to compensate for the higher risk.
That's right. So if you were attracted to the BC yield when it was 8% or 9% or 10% or 11%, I think it got up to 12%.
Yes.
You're looking at the wrong things.
Stock went up when they cut it.
Yeah, now it's back down again. So BC has cut its dividend by 60%. The yield's still high. But so what do we look for in terms of dividends? For us, where do dividends come from? They come from the excess cash flows that companies, they should come from the excess cash flows that a company generates after paying all its employees, keeping the lights on, so to speak, right? And so with this leftover cash flow, it's an easy number to calculate. It's and you know, it's just net income minus capital expenditures, and you've got what's left over. The issue is, and maybe add back depreciation, I missed that one. But the bottom line for that is, if you see a company that year in and year out is paying out more in dividends than the free cash flow that it's generating, you probably are going to have a problem, unless it's a temporary. So like during the pandemic, right? A lot of companies still were paying their dividends, but the business was a zero for a few months, right? You can suffer through that because you know the company has a good balance sheet, and when things recover, the dividend will be fine. But BCE was paying out more than it was taking in for a number of years, and for some strange reason, raising that dividend. So that makes no sense. So what has to happen is the debt goes up too much, and investors eventually figure out that that's not sustainable, and that's why BC's dividend went to 12%, because everybody knows they're going to cut the dividend.
I think, are we picking on BC too much?
We are.